morning and said, the Minneapolis guy came out and said they're going to raise short rates here. He thinks 75 bips in 2011. But my sense is that we're in a tough time. And I think we can all agree that interest rates are going to be higher. The question is, how much? And I don't think anybody, if you knew that, you wouldn't be in the real estate business.
We'll have a lot more deal flow.
I think that's the one thing that you say is that when we talked about deal flow, if interest rates do start to spike, I think it's going to also increase deal flow dramatically because it's going to bring a lot of people off the sidelines saying, oh shit, I got to get out. So I think that could very well really push deal flow even further.
Okay. Bill Gauss.
I have a related question to that, and that is there has been a scarcity premium due to lack of product in the market. Clearly the capital markets are ahead of the fundamentals. If we start to see 2 to 3 times more assets coming to the market, as you suggest, Paul, does that mean a retrenching in pricing, or is there just that much more capital that's going to be flowing in?
You know, it's hard to say. I would tend to think that would take, some of the sizzle off the steak. I would hope anyway. But I think right now there's way more capital than there is deals, and I think it's just until that dynamic changes, it's going to be tough to compete, with what's going on. But look, I'd like to see that. Because I think that will create better opportunities, or opportunities that underwrite, to more realistic kind of assumptions and whatnot. That's my view, but it's hard to say, I think.
Yeah, I think there's 2 sides to the coin. Some people will argue there's still a $600 billion gap that exists over the next 4 years. I saw that argument last week from somebody. Yet that same group that I was sort of listening to and speaking at, they were also just finishing raising $2 billion new money, and they had a negative. About 8 months ago, they had about an $800 million negative queue to get out. Now they have a $2 billion queue to come in. So it's a matter of timing here, I think, and see how fast this all moves. I mean, there's a lot of other things that could occur here that we have to remember in this international world. You've got a lot of money coming out of South America into Florida and other markets, Houston. They're buying, and they don't look at things the way we do. And if you have further Europe scares or international scares as we go along, the U.S. dollar is still, even though we have way too much debt and high GDP and all that, U.S. dollar is still the only real place that people can feel comfortable, and therefore, you could see interest rates stay down, and you could see a lot more money flow in this country than, and you've seen nothing yet.
Okay. One more question. Yes.
Capital flows and global capital flows on a macro basis to real estate. How durable do you see? I think during the run-up 05 to 07, there was a lot of similar panels talking about real estate's now a valid asset class. It's no longer grouped as an alternative investment. I've heard a lot of people talk recently about how it's almost even better than cash core real estate because it's an inflation hedge. But yet knowing real estate, it's a long-term capital-intensive business and very cyclical and illiquid when you need liquidity the most. So how much on a macro basis with these capital flows, whether it's hedge funds or private REITs with mom and pop investors, are really committed to real estate long term, and how quickly can that, do you see maybe that could it move out of real estate just as quickly as it came in?
Well, I think after the last couple of years, real estate's going to be staying in alternatives for a while. Look, I think that when you look at these funds, and you just look at the the demographics and sort of the aging of the the retirees that these funds need to pay, there's going to be a real need for yield, and I think real estate will fill a decent decent part of that, or at least, some part of it, as much as it historically has, I would say. And I think in some cases, I was just at PREA a couple weeks ago, and, there are a lot of funds that are actually increasing their allocations to real estate, because they need the cash flow, they need the yield, they want the hard asset, they need the inflation hedge, because they're looking at what their obligations are going to be 20 years down the road, and they got to meet that somehow, and you're not going to meet it in super safe treasuries, so that they're going to have to reach for risk. And I think that, one of the other interesting things that, seems to be, kind of coming back into the discussion is, last year it was all about core and, the kind of the $2 billion Q in versus the $2 billion Q out. Yeah, you look at what's happened to the price of, trophy assets, and I think the consensus is beginning to shift away from core to let's take on a little more risk and reach for a little more yield. And so I think that's we've been to the movie before, and kind of history, I don't know, it doesn't necessarily repeat, but it rhymes or whatever. So I think that we're just kind of seeing that again. Yeah.
Yeah, I would just say that I think that I disagree a little bit, only in that I do believe that real estate is now an acceptable asset class and something that people feel comfortable and need, as Jeff said, to get into. There's a scenario here. If you think about inflation, and if the fear of inflation becomes real, which, depending on what happens here, this could, right? It costs 10% more to buy a Hershey Kiss today. But I think that you could see a scenario where everybody who is worried about what's going on and that cash that's on the sidelines still, which is still pretty high, if you do get in an inflation scare here, that cash is going to come off the sidelines, and it's going to go into commodities, it's going to go into hard assets, and it's going to go into a lot of others. So I think that there is a scenario of which this could actually speed up in the amount of cash that comes into real estate because of its perceived inflation hedge.
All right. Hey, great job, everybody. I'd ask you all to thank our panelists.
Thank you very much.